Hi, this is Mike Coppell, and we're here today to talk about the recent legislation, TRA 2012, even though it actually was passed in 2013, and what is good about it for McDonald's owner-operators and what's not so good about it. And sometimes things that look like they're good actually aren't, and vice versa. So let's get started. All of you know Mark. Mark heads up our McDonald's operation, and anytime you have questions about your operations or anything like that, feel free to give Mark or email Mark a question. If you can't get a hold of Mark, you can talk to Rich Felto, or you can ask for me, and we'll do whatever we can to help you as far as McDonald's operations are concerned. Here's a picture of me, old, fat, and ugly, along with my direct line number, my cell phone number, and my email addresses, so that you can get a hold of me at any of those contact methodologies. All right, so basically what we're talking about initially is the American Taxpayer Relief Act of 2012. And what we have to remember is that what was going to happen here is that all of the so-called Bush tax cuts and a lot of other things were going to expire, and there were going to be very, very substantial tax increases for just about everybody in the country. And this was an attempt to do two things: to try and put the country on a more even keel and avoid massive tax increases for the middle class, whatever you consider middle class to be. Whether or not that was actually accomplished or not is up to you to look at, but we can talk about that as we go on. Now, long ago, when I was a young man, I was taught by my mentor at Coopers & Lybrand never to do something just for tax reasons. Always do things because it makes good business sense. And that's something that I've tried very hard to live with all these years. And basically that's why in all of the seminars that I'm doing now, I'm putting this little sheet up here that reminds people, don't let the tax tail wag the economic dog. And I think that's very, very important for all of us to understand in this situation. You got to remember that we're in business to make money. Taxes is a fact of life. But what we have to do is make sure that the economics of what we do actually makes sense. Now, I want to start off with three quotes that I saw about this legislation that I personally found funny, and you have to remember that I'm a tax nerd, and therefore some things that I find funny nobody else does. But the first one is, thanks to Congress for keeping its wayward members off the roads and out of the bars on New Year's. Basically, if you remember, they were basically working right up until New Year's and even after New Year's in order to get this legislation passed. The second is, right after this legislation was passed, we heard a lot of senators and a lot of congressmen saying, well, this really isn't that great a legislation, but we had to go along with it to get it done. So there was a lot of regrets that happened here, and there are some things that we're trying to get expanded or fixed or whatever, and that's something that we will continue to work on as the year goes by. The most interesting one is we have to remember that there's always a discussion where we see legislation and you see all of a sudden there's this provision in there that just basically comes out of nowhere and you know, is really designed just to help a very narrow, very, very narrow group of people, and that's very often called earmarks. And this is one here where we say, someone, and this happened to be from a friend of mine, scan the entire fiscal cliff bill for the best tax breaks. Algae and economic development of American Samoa, which I thought was interesting that, you know, that would actually find its way into this very, very important piece of legislation. Now, one of the things that's really interesting here is that one of the things that they were trying to do is not have any increases in taxes for the middle class, whatever middle class is. They wanted the middle class to come out of this at least whole and maybe even better. But what happened here is the payroll tax holiday. You may remember a couple of years ago, the amount that people pay in payroll taxes, paying for Social Security, was reduced by 2%. So that for a family of 4 making $70,000, for example, they paid $1,400 less tax in. That was not renewed. So basically, all of a sudden, that same family of 4 making $70,000 is going to have $1,400 less in their pocket than they would have if the payroll tax holiday had been extended. But that was an extremely expensive provision, which is the reason it wasn't extended. And it was always intended to be temporary. Of course, we have a lot of things that are supposed to be temporary in the tax law and just continue forever. But this is one that basically means that a lot of middle-class people and so on are actually going to wind up having less cash in their pocket because of this. We kind of expected this. We expected that the 39.6 highest bracket was going to come back. If there's any good news here, it came back at a higher level than we expected. Basically, what we have is married filing joint. It starts off at $450,000 and single at $400,000, and you can see head of household and married filing separately there. Now, my little cartoon on the bottom is there because what is really interesting here, and we're going to talk about what we do with marriage penalties and things like that later on, but notice there's a marriage penalty here. If you have 2 people, a husband and wife or whatever, a married couple, and they each earn $300,000, if that's the case, there will be no 39.6% tax. Whereas if they get married, $150,000 of that taxable income, assuming everything is taxed, is going to be subject to the 39.6% bracket. So that what we have here, and we're going to see it again and again and again, is there's actually a marriage penalty built into this legislation. The other thing that is interesting is every year, those of you that come to our tax seminars or listen to people, hear people talk about we have to index the alternative minimum tax. We'll talk about alternative minimum tax in a minute, but we have to index that for inflation. One of the things that is interesting about these brackets is that this is not indexed. This is fixed, so that unless people come in and legislatively come in and index these, what we're going to wind up seeing is more and more people falling into this high bracket just because of inflation. So, that was kind of interesting also. Capital gains and dividends, and this is not all capital gains. Some capital gains, such as the gains on your home, which are excluded, up to $500,000. Certain sales of an active business, as long as you actively participate in the business, a lot of that capital gains is going to be included and so on. But basically, your trading of stocks, if you sell McDonald's at a big gain, for example, that's going to be taxed at 20%. Your McDonald's dividends is going to be taxed at 20%. Same threshold as the 39.6%, $400,000 and $450,000. Same thing is true there. I want everybody to remember when we talk about 20%, 20% for a lot of people is a misnomer, because what you have to remember is that as part of PPACA, also Obamacare, what we also have here is for the net investment income, and we've talked about that in other seminars. We'll talk about that a little later. But net investment income has an additional 3.8% tax, and that starts at a much lower rate. That's at $250,000 and $200,000 of adjusted gross income. So that's at a much lower rate, so that basically we're going to see that for almost anybody that has is up with the 20%. It's really not going to be 20%. It's going to be 23.8%. Now think about that for a second. In 2012, you had a capital gain rate, a dividend rate of 15%. It is now 23.8%. That's approximately almost a 60% increase in the rates for capital gains and dividends, which is really an astronomical increase. One thing I want people to think about is that if you made a sale in 2012 and that sale was an installment sale, you got some of the money now and you're getting money as the years goes on. If that's the case, you want to consider electing out of installment sale in order to take advantage of the 15% instead of the 23.8%. Now, there is a trap here, and the trap is that if you do not get your money on an installment sale, that is a capital loss. And as some of you know, capital losses can only be used to offset capital gains plus $3,000 a year. So that if you have a big payment in the future and don't get it, this could cause you a lot of trouble and not be able to use it for years and years. One of the other things that was really interesting here is, for example, if you sell your business, if you sell your store, as you know, any of you that have done it, you know that what's going to wind up happening here is you're going to have some recapture on the depreciation that you've previously taken. And those recapture rates, for example, in real estate are 25%, which meant there was a 10% spread between regular capital gains and the recapture rates. Now it's only 5%, which is kind of interesting. There's a lot of discussion that we may see some of that recapture rate go up in order to keep that margin the way it was at 10%. Now, a lot of you, hopefully, did a lot of estate and gift tax planning last year in 2012. We'll talk about some of that in a minute. And you set up trusts, and hopefully you didn't die. So we're not going to talk about estates. But estates and trusts are going to have their own tax rates. And what's going to happen here is that 39.6% and the 20% and the 23.8% are all actually going to come at trusts, except they're going to start at a really low rate. They're going to start at about $11,500. So one of the things that's going to be really important for us to do here, and we'll talk a lot about later in the year during the fall, is how much we should be distributing out of trust to beneficiaries in order to minimize the tax. In other words, if the beneficiary and the trust are really two pockets in the same pair of pants, how do we make sure that we make the distributions out to the beneficiaries so that basically the total net tax between beneficiary and trust is minimized? And that's something that's take a lot of planning as we approach year end. Go back to AMT for a minute. One second. And like I said earlier, what has finally happened here is they made AMT index permanently for inflation. Every year we hear that what had been adjust for inflation, adjust for inflation, adjust for inflation. Now they've finally done it. So that basically we'll never have to talk about that again. But remember what I said, and this is going to be true of the other thresholds that we talk about. Those were not indexed in inflation in this legislation. So, you know, that's really interesting as to what's going to happen there. The other thing that I want to talk about is that non-refundable personal credits can be used against AMT. Now, you don't have a lot of personal credits. You as owner-operators have a lot of business credits. So what you have in a business credit, for example, if you're using work opportunity credits, what's important here is a work opportunity credit is a non-refundable credit, but it's a non-refundable business credit. So what winds up happening here is you cannot use your work opportunity credits and any other business credits that you get in order to offset AMT. You can only use it to offset regular tax. So if you're getting work opportunity credits, we really have to be very, very careful in planning what your tax situation is going to be in order to make sure that you can use those credits. We now go back once again a few years, and we're going to have a phase out of your itemized deductions. There's some really interesting things in this situation that are different from last time. The threshold for the limitation, which is again a third definition of rich people, is $300,000 of adjusted gross income, married, filing, joint, and $250,000 for single, as opposed to the other definitions that we've already talked about. But what's interesting here is that not all itemized deductions are phased out. So, for example, your medical expense, investment interest expense, casualty losses, and the ever popular wagering losses will not be phased out, whereas some other itemized deductions, such as real estate taxes and home mortgage interest, are going to be subject to phase out. And the really one that caught me by surprise is that charitable donations are also going to be subject to a phase out. And what's going to happen here is up to 80% of those eligible itemized deductions can be phased out in any year. And the calculation is it's 3% of the amount in excess of the threshold. So let's suppose you're a married couple and you have adjusted gross income of $1 million. If you have $1 million of adjusted gross income, then you have $1 million minus $300,000 is $700,000 times 3% is $21,000 that you're going to lose, times approximately 40%. So 40 of the 4%. So 4% of $21,000. You know, it's a few bucks that you're going to have to worry about. So all of a sudden you're going to have you know, in excess of $20,000 that you're going to lose in that situation. 3% of $700,000. Also, your personal exemptions are going to get phased out, and they're being phased out same threshold as your itemized deduction phase out, except in this case what happens is that the phase out is 2% for every $2,500 of adjusted gross income. Now, one of the things that we're going to be looking at in this situation is we're going to want to talk at year end about whether or not it is possible, based upon the facts and circumstances, to give your child their own exemption instead of you taking it, since you're going to face, especially if yours is going to be phased out and they can use theirs for other things. And that's something that we're going to talk about at our year-end tax planning seminars. The other thing that we'll talk about at our year-end tax planning seminars is bunching of fixed assets, of your itemized deductions. So what we're going to talk about is that you're going to sit here and you're going to be able to take your itemized deductions, and because of the phase out, you're going to want to have a lot of them in one year and less of them in another year, so that you maximize the amount over the course of time of the itemized deductions that you'll be able to do, and we'll give you a lot of examples of that later in our year-end tax planning seminars. Now, I know that not that many McDonald's owner-operators have 401ks, but if you do have a 401k that is available to you, one of the things that you can now do is, assuming that the plan allows it, you can convert your traditional IRA to a Roth IRA, Roth 401k rather. This, whether you should be doing this or not, whether it's a good move, is a very, very complicated situation. I strongly recommend that you sit down with a good financial planner. We're very lucky here at Gray Gray. We have Dan Romano, who can sit here and go through with you whether it makes sense to have a traditional or a Roth 401k or IRA for that matter, or you can give me a call and I'll make whatever introductions are necessary in order to get you the information or help you with it. IRA distributions to charity, really we're not going to deal with because that all happened in January. All your educational items all come through and they were all extended. The American Opportunity Credit is there. Deduction for tuition expenses, etc. Those are all there and all extended through 2013, except the American Opportunity Credit, which is extended to 2012. Here's a list of all the other miscellaneous things that get extended every year for a personal situation, and you can read them as well as I can. Let's talk about estate and gift, and we want to talk about estate and gift because a lot of things came here as a surprise. You know, as the discussion was happening towards the end of 2012, you remember everybody expected that the amount of the exclusion was going to be reduced significantly. And what happened that surprised us is basically the $5 million exclusion was made permanent and it's indexed for inflation. So actually your lifetime exclusion in 2013, it actually is up $125,000 from where it was in 2012, and this came as a real surprise to us. Same thing is true about portability. Supportability basically means that if, let's suppose when I'm off cross-country skiing by myself, I get run over by a moose up in New Hampshire, basically any of my lifetime exemption that I haven't used automatically flows over to the wonderful Tina, so that if there was $5 million of exclusion that I hadn't used, that would be added to her $5 million, and she would have an exclusion of over $10 million that she can give to our kids. Supportability just, it talks about being able to transfer that back and forth. The estate tax rate, gift and estate tax rate, went up 5% for the maximum amount, but that you don't have to worry about that until after you're up there at $10 million that you've given away. All this is made permanent. No other changes, which we also surprised us. We thought there would be things happening with GRATs. We thought there may be things happening with discounts. None of that happened. They're still on the table, but as of now, none of that is there. There's one more thing I want to talk about in the gift and estate area, and that is that with the exception of 5 states, all states have estate taxes, usually fairly significant estate taxes. So, for example, here in Massachusetts, you have a maximum estate tax rate of 10%. However, there is no gift tax rate. So if you give your money away early before you die, under $10 million, you're going to wind up with no federal rate because you're under the lifetime exclusion, and you're going to give it away, and you're going to have no gift tax rate in Massachusetts or New York or Connecticut or California or any of the other states that have it, because they have estate rates, but they don't have gift rates. So that, gifting is still a very, very strong thing that we have to talk about. 179, we always refer to 179, the code section, and basically in this case, what we have is that 179 at $500,000 with a $2 million phase out is retroactive for 2012 and 2013. This is really, really good news for everyone. So that basically it means that if you go out and you can automatically expense up to $500,000 of new equipment for a store or whatever you have. The other thing that happened is bonus depreciation was also extended at the 50% rate once again for 2012 and 2013. So this again is really good. We'll be keeping track of what happens with that as time goes on. But basically, this means that you'll be able to depreciate immediately an awful lot of assets. Now, one thing I want to caution everybody about is that you have to remember that depreciation is only a timing difference. So what's going to happen here is you're taking your depreciation early, so what's going to wind up happening is you're going to reduce your taxes now, but they're going to be lower later. Now, I do understand that the McDonald's owner-operators, that the McDonald's area is a capital-intensive area, and you're always making very substantial improvements to your stores and everything else. But just remember that you're taking advantage of something today, and you're going to wind up having more taxes in the future because of the use of 179 and bonus depreciation. The other really good news is that there is a 15-year life on your restaurants in 2012 and 2013. Obviously, really, really important for people that are doing MRPs or rebuilds. One of the things that we're strongly advising people to do in this situation, and I don't want to get too deeply into it, but we're strongly advising that people make sure they have a cost segregation study, that the cost of the building, of a cost of an MRP, the cost of a rebuild, that those things especially are broken down into the specific components of a building, because that's really going to be required for the new repair regulations that become effective in 2014. So you want to plan to have that set up ahead of time. Now, like business credits, all the business credits are once again retroactive through 2013, so that your WOTC and any other credit is indeed available for 2012 and 2013. You have to be very, very careful here because of the fact that because substantially all of you are in some type of passive, in some type of some type of pass-through entity, so that basically all of this income, all of the deductions, all of these credits are going to flow through to you. And as we discussed, these business credits cannot be used against your alternative minimum tax. So if you're in a fairly high tax state, like New York, like California, like Massachusetts, for example, then what's going to wind up happening is that some of these credits may not be able to be used, and basically they just wind up being carried forward and carried forward forever, and that really is not helping you. So that you really have to pay attention. Now, we think actually fewer people are going to wind up in alternative minimum tax because of the 39.6% tax bracket that's in there. But it's going to be very important for you to sit down and actually push the pencil, or have us push the pencil, and see exactly where you are with regard to alternative minimum tax in this area now. If you're an S corporation, you want to talk about big tax, built-in gains tax. If you are an S corporation and you're thinking about liquidating the corporation, selling the corporation, talk to us about the big tax and what's there. It's an extremely complicated area. I don't want to spend a lot of time with it. It's very, very important if you're an S corporation and you're talking about liquidating that S corporation and making sure you only have one level of tax. Otherwise, you wind up with built-in gains. But once again, we have a short period of time for the built-in gains. If you're talking about that, please give me a call and we'll walk you through it. I want to talk about the repair regs. I mentioned them very briefly before. What we now have is the repair regs have been postponed. The final repair regs are supposed to come out sometime in the second quarter of this year. When they come out, we'll update you on all of the information that is required for them. Now, the only issue is if you did a major repair job to your store, to one of your restaurants. So, for example, if you totally replaced the roof, you may want to consider, and you really have to sit down and talk to us, you may want to consider whether or not you want to do early adoption of the repair regs, because it can be more beneficial, significantly more beneficial to you to do that. It's something that I don't think is going to affect a lot of people. It'll affect a few people, if that is the case, please pick up the phone, give us a call so we can talk to you about it. If you had a major repair to one of your stores, there's more to come. We know that right now sequestration is going to start supposedly on March 1st, which means we have massive across-the-board cuts. All parties agree that that is bad for the economy and is going to cause significant problems. But as of today, they don't know what they're going to do about it. We'll keep our eye on that. It appears there are going to be tax increases of some type to try and minimize this or eliminate the sequestration. And then we have the debt ceiling coming up the end of March. So basically, once again, we're going to have another whammy. And once again, we may have more tax situations that we have to talk about in that area, and we'll keep you posted on that. All of this comes down to something that I want to just mention very quickly. I've been doing taxes. I've been a tax nerd for 40 years, and I've seen a lot of things come and go and everything else. And one of the things that I have learned is that in the tax area, the definition of permanent is until Congress changes it. So just because this legislation says it's permanent doesn't mean it's going to be. We could still see some very significant changes in the tax law, even though people say it's permanent. We're going to keep track of what's happening. We're going to keep track of what's happening on sequestration, on debt limitations, on the entire package of tax reform that may come down the road this summer, and all of those things, so that basically we're going to have all of that covered. And there's a lot to digest here. Once again, there are all my contact information, my direct line number, my cell phone number, my numbers from my email. I suggest the easiest way to get a hold of me is through my cell phone. So I suggest that's what you do. You can also email me and ask me any questions. We'll be keeping track of all of this as time moves on. If you have specific questions about how this is going to affect you and your business this year and in the future, please feel free to give me a call. Thank you, and have a nice day.